You know that moment when you realize you made money from an investment, but then remember Uncle Sam wants his share too? Yeah, that's the sting of capital gains tax. But what if I told you there are perfectly legal ways to keep more of your profits instead of handing them over to the government? Today, you'll learn exactly how smart investors pay less capital gains tax legally, and how you can too. Number 1. Understanding capital gains tax. Before we dive into the tricks, let's start with the basics. Capital gains tax is what you pay when you sell an investment, like stocks, real estate, or crypto, for more than you bought it. There are two types of capital gains: short-term and long-term. Short-term means you held the asset for less than a year. These are taxed like your regular income, and that can be high, sometimes over 30% depending on your income bracket. Long-term means you held the asset for more than a year. These are taxed at lower rates, usually 0, 15, or 20%. Here's the first simple secret. The longer you hold, the less you pay. For example, imagine you bought a stock for $10,000 and sold it 6 months later for $15,000. That $5,000 profit gets hit with your regular income tax rate. But if you waited one more year and sold after 12 months, you might only pay 15% or even 0%, depending on your total income. So patience literally pays off. Number 2, use the power of offsetting losses. Let's be real. Not every investment wins. But what most people don't know is that your losses can actually save you money on taxes. Here's how it works. If you lost money on some investments, you can use those losses to offset your gains. Say you made a $10,000 profit from one stock, but lost $3,000 on another. You only pay tax on the net gain, $7,000. And if your losses are greater than your gains, you can deduct up to $3,000 of that loss against your other income, like your salary. Any leftover losses can be carried forward to future years. It's called tax loss harvesting, and it's a smart move that big investors use all the time. For example, many wealthy investors sell underperforming assets near the end of the year just to harvest the losses. Then they buy similar assets right after, keeping their portfolio strong while locking in tax benefits. Number 3, take advantage of the primary residence exclusion. Here's a powerful one for homeowners. If you sell your home and it was your primary residence for at least 2 of the last 5 years, you might not have to pay any capital gains tax at all, up to $250,000 of profit if you're single, or $500,000 if you're married filing jointly. That means if you bought your home for $300,000 and sell it for $800,000, you could legally walk away with $500,000 in profit and pay zero tax. But remember, this only applies to your main home, not rental properties or vacation homes. This is one of the biggest legal tax breaks in the USA, and many people don't even realize they qualify. Number 4, invest through retirement accounts. Want to avoid paying capital gains tax completely for now? Use retirement accounts. If you invest through accounts like a 401k or an IRA, your gains grow tax deferred. That means you don't pay any capital gains tax when you buy or sell within that account. With a Roth IRA, it gets even better. Your investments grow tax-free, and when you withdraw the money in retirement, you don't pay any taxes at all, not even on your gains. Let's say you invest $10,000 in a Roth IRA, and after a few years it grows to $30,000. You can withdraw that $20,000 profit completely tax-free. It's like having a magic shield that protects your profits from the taxman. Number 5, consider a 1031 exchange for real estate. If you own investment property, here's a powerful legal strategy most beginners have never heard of: the 1031 exchange. It allows you to sell one investment property and reinvest the money into another like-kind property without paying capital gains tax immediately. The catch is, you must reinvest the proceeds into another property within 180 days. For example, imagine you sell a rental property and make a $100,000 profit. Normally, you'd owe tax on that gain. But with a 1031 exchange, you can roll that profit into another property and defer the tax. You can keep doing this over and over, deferring taxes for years or even decades. And when you pass the property on to your heirs, the cost basis resets, meaning your heirs may owe little or no tax on those past gains. It's one of the ultimate wealth-building loopholes. Number 6, hold investments until death, step up in basis. This one sounds a bit dark, but it's actually one of the most effective legal tax moves. When you pass away, your heirs get what's called a step-up in basis. That means the value of your investments resets to their market value at the time of your death. Let's say you bought a stock for $10,000 decades ago, and it's now worth $100,000. If you sold it while alive, you'd owe tax on $90,000 in gains. But if your heirs inherit it, their cost basis becomes $100,000. They can sell it immediately for that amount and pay zero tax. It's why so many wealthy families pass assets through generations while legally avoiding capital gains taxes. Number 7. Move to a tax-friendly state. Believe it or not, where you live can make a huge difference in how much tax you pay. Some states, like Florida, Texas, and Nevada, don't have any state income tax or capital gains tax. If you live in California or New York, you could be paying 10% or more just in state taxes on your gains. So when people retire or sell large assets, some choose to move to states with lower or zero capital gains taxes. Of course, moving just for taxes isn't for everyone, but if you're planning a major life move anyway, it's worth considering how your new state affects your wallet. Number 8. Donate appreciated assets. Here's a strategy that makes your heart and your wallet happy. If you've got stocks or assets that have gone up in value, you can donate them directly to a qualified charity. You'll get a tax deduction for the full market value, and you won't have to pay any capital gains tax on the appreciation. For example, if you bought stock for $5,000 that's now worth $20,000, donating it saves you from paying capital gains tax on that $15,000 profit. Plus, you get a charitable deduction for the $20,000. It's a win-win. You help a cause you care about and keep more of your money. Number 9. Use Opportunity Zone investments. Opportunity zones are special areas designated by the government to encourage investment. If you invest your capital gains into an Opportunity Zone fund, you can defer your capital gains tax until 2026, reduce the tax you owe. And if you hold the investment long enough, usually 10 years, your new gains from the fund can be tax-free. It's a powerful incentive designed to boost economic growth while helping investors legally pay less in taxes. But remember, these are more complex investments, so always do your homework or consult a financial advisor before jumping in. Number 10. Time your sales strategically. Timing can make a big difference in how much tax you pay. For example, if your income is lower in one year, maybe you took a break from work or retired, you can plan to sell your investments during that low-income year. That might qualify you for a lower long-term capital gains rate, even as low as 0%. So always look at your total income before selling big assets. Sometimes waiting a few months can save you thousands of dollars in taxes. Number 11. Use family gifting. The IRS allows you to give up to $18,000 per person per year as a gift without paying gift tax. If you give appreciated assets like stocks to family members who are in a lower tax bracket, they might pay less capital gains tax when they sell. For example, a parent could gift stock to a college-age child who earns little to no income. When the child sells it, they might qualify for a 0% long-term capital gains rate. It's a great way to share wealth and reduce overall family tax burdens. Number 12. Use a health savings account, HSA. If you have a high-deductible health insurance plan, you can open a health savings account, or HSA. This account is like a triple tax advantage powerhouse. Your contributions are tax-deductible, your money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. But here's the secret most people don't know. You can invest the money inside your HSA. That means your investments grow without capital gains tax. It's basically a stealth retirement account that can also save you thousands in taxes while covering future medical costs. For example, if you invest $5,000 in an HSA every year for 10 years and let it grow tax-free, you could end up with tens of thousands of dollars in tax-free gains. Number 13. Start a small business or side hustle. Owning a business opens up a whole new world of tax benefits. When you invest in assets for your business, like equipment, vehicles, or even office space, you might qualify for deductions or depreciation, which reduce your taxable income. And when you eventually sell the business, you may qualify for a special exclusion under Section 1202 if your company is a qualified small business corporation. This exclusion could let you avoid taxes on up to $10 million of capital gains. Even if you're just starting a small side hustle, business ownership gives you more flexibility in how income and gains are structured, helping you legally minimize taxes. Number 14. Invest in index funds and ETFs. Not all investments are taxed the same. Actively managed mutual funds can trigger capital gains taxes every year because the fund manager constantly buys and sells stocks inside the fund. Index funds and ETFs, on the other hand, are more tax efficient. They don't trade as often, which means fewer taxable events. That means you can hold them longer, watch your investments grow, and only pay capital gains tax when you decide to sell. It's a quiet, hands-off way to let your money work for you while keeping taxes low. Number 15. Utilize qualified small business stock, QSBS, exemption. If you invest in a startup or small business that qualifies under Section 1202, you could eliminate up to 100% of your capital gains tax when you sell. To qualify, you must hold the stock for at least 5 years, and the company must meet specific criteria, like being a C corporation with under $50 million in assets when you invest. Imagine investing in a small business early and later selling your shares for a massive profit, all completely tax-free. That's how early investors in successful startups have walked away with millions without paying a dime in capital gains tax. Number 16. Split your gains over multiple years. If you know selling an investment will lead to a huge profit, you can sometimes split the gain across multiple years to stay in lower tax brackets. This can be done through an installment sale. Instead of receiving all your money at once, you spread the payments, and therefore the taxable gains, over several years. For example, if you sell a property and receive payments over 5 years, you only pay tax each year on the portion you receive. It's a simple but powerful way to smooth out your tax bill and keep your rate low. Number 17. Take advantage of employer stock options wisely. If your company offers stock options, the timing of when you exercise and sell can make a big difference in how much tax you pay. If you exercise and sell immediately, your gain may count as ordinary income. But if you exercise and hold the stock for more than a year, it can qualify for the lower long-term capital gains rate. Some employees use this strategy to build wealth while legally paying far less tax on their gains. It's all about timing and planning ahead. Number 18. Gift to a donor-advised fund. If you want to support charities but also lower your tax bill, a donor-advised fund can help. You can donate appreciated assets, like stocks, and get an immediate tax deduction for the full value. Then, you can distribute the money to charities over time. This allows you to remove the asset from your taxable portfolio, avoid paying capital gains tax on the gain, and control how and when your charitable gifts are made. It's one of the most flexible and powerful charitable giving strategies out there. Number 19. Take advantage of inflation adjustments. Capital gains tax rates don't automatically adjust for inflation. That means even if your investment just keeps pace with rising prices, you could still owe taxes on phantom gains that aren't real profits. One way to minimize this is to invest in assets that naturally outpace inflation, like real estate or stocks, so your after-tax returns remain strong. Or use inflation-protected securities like TIPS to balance your portfolio while keeping gains relatively stable. Being strategic about inflation can help you avoid paying taxes on profits that don't actually increase your real wealth. Number 20. Reinvest dividends automatically. Many investors receive dividends and let them sit as cash. But if you automatically reinvest those dividends, you can compound your returns over time and delay realizing capital gains until much later. This strategy doesn't eliminate taxes, but helps reduce how often you trigger taxable events. Over time, those reinvested earnings can grow significantly, giving you more control over when and how you pay taxes. So what's the big takeaway? Paying capital gains tax is unavoidable, but how much you pay, that's something you can control. The wealthy use these exact legal strategies every single year to minimize taxes, grow wealth faster, and pass it on more efficiently. And now, you know how to do it too. Remember, the key isn't about cheating the system. It's about understanding it better than most people do. If you could legally keep more of your hard-earned profits, wouldn't you want to? Which of these strategies do you think would work best for your situation? Let me know in the comments.